there. I first met Mike, interestingly, when Mike and his group, Dolphin Capital, were looking at buying one of my companies. And so this has been about 8 or 9 years ago, and Mike was pretty much fresh off your MBA, not too long. And so Mike has really had a stellar career that has been very diverse. He's the CEO of Winder Farms, which is an online grocer that delivers farm fresh food to 40,000 customers weekly. I cannot tell you how much they have changed that business from what it was when they purchased it, about a decade ago, to the present. In California, Nevada, and Utah, the company is a sort of a farmer's market on wheels, as they like to describe it, and it focuses on its product section on local and all-natural dairy, produce, bakery, meat, and prepared foods, and they deliver those directly to customer homes. But he's also a partner at Dolphin Capital, not just the CEO of one of its companies. It's a private equity group that invests in middle market businesses with significant growth potential, and he's on the board of Ragnar Events, which is another company owned by Dolphin. It was a student company that started right out of Brigham Young here, which then they acquired and helped grow. Michael is a great talent and a wealth of knowledge, and I hope that you'll give him your full attention today. It's my pleasure to welcome Mike. Join me in welcoming him into the lecture series.
All right, well, thanks for having me today. I love teaching this class because, as Scott mentioned, Ragnar is a company that came out of BYU that we invested in. But we also had 2 other companies that we've invested in that were actually, they were student projects. And so I think that there's no better time to be an entrepreneur than when you're in school. Actually, my first entrepreneurial experiences were, as an undergraduate here and as a graduate student at Stanford. And I had a lot of success being a student entrepreneur. You just have such great potential here. You have no downside risk. You've got, flexible time. So if there's anybody who, my hope today is I inspire some of you to really become entrepreneurs. And what I'm going to do is I'm going to share with you kind of my entrepreneurial journey and try to demystify the process of becoming an entrepreneur. And I know that a lot of you are entrepreneurs already. I've mentored some of the student teams here, and I'm just amazed at the creativity and energy that comes out of this place. So while I'm one entrepreneur, there's probably 50 that are sitting right here, and I'll just share you my experience and try to demystify the process for you. All right, great. Okay, so anybody know these sandals? So my first experience was here at BYU. My roommate worked for Foot Locker. And he was at Foot Locker one day, and he called me. He's like, "Hey, Foot Locker's decided to get out of the sandal business because they want to, their athletic shoes. And so we're selling, all of our Birkenstock sandals for $9.98 a pair. You should come down here and get one." So, and at the time they were selling for like 85 bucks a pair. And this is back in 1994, 94, 95. Actually, let me think about that. It was 1994. And so I went there and with one of my other roommates, and we saw this whole table filled with these Birkenstock sandals. There were about 50 of them. And we're like, man, this is a great deal, $9.98 a pair. These things retail for over 80 bucks. And so we had the bright idea, well, let's just buy all of them. And so we bought all of them at the University Mall, and then we rented a truck and we drove to all the other Foot Lockers in the state of Utah, and we ended up buying 300 pair. And so at the time I was single, I had some credit cards, and he had some credit cards, and so we basically maxed out all of our credit cards to buy these sandals. And so our entire apartment was full of these Birkenstock sandals. And so we decided to try to sell them. Because we were BYU students, we had the great idea, we'll sell them door to door, right? So because everybody sells sandals door to door. And so we go through the different apartment complexes, we knock on doors, and it's just not working. We show up with these sandals, like selling them out of the back of our car. Nobody's buying these sandals. And so we have the bright idea to bring it out by what is now Vasa Fitness. I think that's what it's called, by King Henry Apartments. and we got a bunch of speakers, and we made it kind of a big party, and we passed flyers around, and over the course of 3 Saturdays, we sold all of our Birkenstocks. And so I ended up making several $1,000s on that, and I thought, man, that was like 3 weeks worth of work. I made all this money. And at that point, I thought, you know, I like this entrepreneurial thing. So that was my first experience here. And so, but I was an undergraduate in political science, and so I had absolutely 0 employable skills. And for all of you liberal arts majors out there. And so I got a job working for the state legislature as kind of a legislative aide. I would track bills as they went through the process of a bill becoming a law. And this is kind of in the early days of the web, and I decided to build this simple HTML app using literally HTML for dummies to track bills as they move through the process. And there was just a series of like 10 HTML pages. And this is, in the early days of the web, and people thought I was a freaking genius. And so, I had like these, very limited technical skills, and I leveraged that into a job at Anderson Consulting. And I spent 2 years there where they tried to turn, me as a political science person into a highly technical person who can write programs. And so after a couple years there, I decided I'm not going to be a top flight technologist. And so I decided to take kind of my technical background, as limited as it was, and apply that to something more on the product and marketing side. And I joined this company called Financial Fusion, and we made internet banking software. And I became their first product manager. And this was kind of in the early days of the web, and this company just took off. And I became the VP of products, and then we got acquired, and then I became kind of, I ran a part of a big public software company. And my point in all this is that, I found a way to leverage my experience from one to another. So I had some technical skills that got me my first job, and I got some more skills there, and I said, okay, I want to be a business person, so I used that to kind of leverage into the business job. And so the point here is kind of to build a skill set. So at this point, the economy turns bad, and I decided to go get my MBA. And when I was at Stanford, I had this idea, because I was a VP of marketing at this one company, to start a technology trade show business. And what I had learned when I was running marketing is that we spent a lot of money on trade shows. And so while I was in school, me and a couple friends, we started this business to produce trade shows. And so now I was leveraging my last experience in buying sponsorships at trade shows to start this new company that produced trade shows. And I started 3 businesses while I was in an undergraduate, and this is the one that really took off. And on the day I graduated, we sold this company for a decent amount of money. And my point here, okay, so anyway, what's my point here? My point here is that I tried to develop skills along the way that I could leverage into my next thing. I think it's really hard sometimes to, like I work with students here who want to start a business in real estate, and they know absolutely nothing on real estate. And they tend to never get that business off the ground, or they tend to fail. I'm working with another person right now another student here, I think he just graduated, but he has a very deep volleyball background. And the company's called Volumetrics. And he's leveraging that background to now produce volleyball software, and they are absolutely crushing it. And so I guess my point is to try to build some skills and experience, because I think that will make you a more successful entrepreneur in the long term. So anyway, so after this experience, I decided that I wanted to be in a position where I could not just be involved in one business, but that I could be involved in many businesses. Kind of, portfolio diversification. So I didn't want to have all my eggs in one basket. I wanted to have, maybe a smaller piece, but in multiple different businesses. So I partnered up with some people that I worked with at the software company, and we started a firm called Dolphin Capital Group. And What Dolphin was, what it started off as, is we started by making small investments of our own money. And as we became more successful, we were able to raise money from outside parties to then make greater investments, and we get a piece of the action. It's how all private equity firms work. We get a management fee, and we get carry on our upside. And so we started this firm called Dolphin Capital Group. It's really what I spend my time on today. And these are some of the portfolio companies. I'm going to take you through a case study of Winder Farms. We also own a company called Manduka. Anybody here familiar with Manduka? You have their mats? So they're the leading provider of yoga mats. Through this company, we also own a firm called Yogi Toes, which makes yoga towels. And so that's been a new fun business we were a part of. Ragnar Relay, who here has run a Ragnar? Oh, we got to get some more runners in here. So if I would have asked that 5 years ago when the guys had just come out of the school, probably half the people here would have ran a Ragnar. But it's a ultra distance running relay race company. They produce races now, 30 of them across the country. Again, founded by students, doing great. Great Salt Lake Artemia, we harvest brine shrimp out of the Great Salt Lake. Foundation Source is a software company that manages the back ends of private foundations. So if like the Gates Foundation, if you get to a point where you can have your own foundation, they'll manage the back end for you. And then Ken Craft is a local candy company. These are just some of the brands that we're associated with. Okay, so my point in this intro is there's lots of paths to entrepreneurship. I think mine is quite varied. The businesses that I'm involved in are quite varied. The entrepreneurs that I know are not all cut from the same cloth. Some are shy and some are outgoing. Some are smart and some are not very smart. Some are good with people and some are not. So don't let prototypes of entrepreneurship scare you away from that. I was blessed to find really good mentors early in my career. My two partners today in Dolphin Capital Group are the founders of the software company that I was with, now 15 years ago, and they've been great mentors for me. And I think that's been a real key for me. The be good at something, I've talked about that. I've done all of this without any cash, without any financing from my parents. It's all been about leveraging credit cards and taking risks. You do not have to be from a rich family to be an entrepreneur. In fact, most people that I do know are not. College is a great time to start a business. I love what I do. I mean, I could be here 3 o'clock on a midweek. I can go on Friday I went skiing with my kids. Tomorrow I'm going to go biking in the morning. I work hard, but because I'm an entrepreneur, I have flexibility in my schedule. And that's probably the best part about doing it for me. Okay, so the virtues of creating a business. A couple years ago, I was here, and a student came up to me afterwards and said, "Oh man, I loved your talk. I'd really like to be an entrepreneur, but I'm going to be a biology major because I want to make the world a better place." I'm like, okay, biology majors can do great things for the world, but so can business people. And I just want you guys to remember that I believe that business and capitalism has been one of the greatest forces for good in lifting people out of poverty and making them self-sufficient. And I think that if you are the right type of business person, you can have an enormous impact on the lives of others. I think it's a very worthy pursuit. Every day that I go to Winder, I think that company supports 300 families. And if you could be a great employer, you really have a big impact on the family. So that's my plug to be in business. Okay, so I'm going to take you through this case study of a company that we bought and kind of tell you the ups and downs. There's a series of research that's happened recently on something called search funds. Anybody here familiar with a search fund? Okay, if you're interested in being an entrepreneur and buying your own business with using none of your capital, get online and search for search funds. Search funds are students who graduate from college who raise a small amount of money to pay themselves a salary while they go out and they try to buy a business. And so you'll go out and you'll raise a couple $100,000 from investors who want to put more capital to work, and you pay yourself to go and search for a business to buy. That's not necessarily what we've done here in Winder Farms, But it's analogous, and I want you to know that you can do this without having to pull a capital behind you. So search funds. If you're interested, look it up. Okay, so Winder, I'm going to give you the story of what we've done here. Yeah, I think the problem with these types of lectures is it sounds like a one-man show. It's absolutely not a one-man show. It's an ongoing story. There's 300 people who work there. And so I think that's important to be said. So when we bought the business, it was about $10 million in revenue. And it was a typical old family business where it had been underinvested in for years. They had no technology, and they had a very diverse shareholder group. So what happens is if your great-great-grandfather builds a business, when he dies, he passes it down to the next generation. And when they die, they pass it down to the next generation. Happens all the time in family businesses, so that when it gets a couple of generations away, nobody owns enough of it to really care about it or to write a check into it to improve it. And that's basically what had happened here. So great brand, undercapitalized, 10th oldest business in Utah, founded by a guy named John R. Winder, who was in the first presidency of the church. So it's a really kind of an old legacy brand. And so at this time, we were looking for kind of a bigger company to buy. And so we looked at Winder and we really liked it. We looked at it as a company that could become an online grocer. So it had one business model that was kind of this old farm-based dairy. And we looked at it and said, well, but they deliver things to people's homes. What if we could put the ordering system on the web and we could expand beyond dairy and create this farmer's market on wheels? That was our vision. And we thought that what we're good at is we're good on the technology side. We had just built a software company that was sold. We're good at marketing, and so we can inject that energy into the company and have something really cool. The other thing I like about it is I like going after businesses that serve massive markets. So the food market is a $1 trillion industry. It's about 12% of GDP. Less than 1% of it is bought online today. And so I think there's going to be a lot of companies that succeed in this space, and we just want to be one of them. I'd much rather go after a market that has billions of potential than one that has millions of potential. And so we saw that here. And it just seemed fun. When we went to the business, it had lots of moving parts. It had cool people. It had this fun brand. It was something that I thought I could get excited about. And so that's why we pursued the deal. Any questions at this point? Have I bored you to tears? Okay, so let's see here. Okay, so what I like to look at is when I'm looking at a business, what is it that makes the business model work? We've got a company right now that we're struggling with, one of our businesses, because we have a hard time defining its sustainable competitive advantage. How is it in your mind that you can convince yourself that a company can succeed long term? Well, it's because if it has something unique and differentiated about it. And what I liked about this business is, a couple of things. One is this concept of a standing order. In most businesses, you have to convince a customer to come into your store or get on your website and buy something from you every week. What we liked about this business is that it had a subscription model. Somebody signs up, and then they just keep on paying you until they tell you to stop. And so I like that type of recurring revenue model for businesses, and this one that definitely has that. We have other businesses that have that same element, recurring revenue so that you don't have to be making sales all the time. The other thing that we like about this business is it has branded products. So if you're a retailer, a typical food retailer, you sell products for about a 25 to 30% gross margin. So if you sell something for $1, you're making 30 cents, and then from that you're paying all of your overhead, your sales and marketing, your executives, your leases, all of that other. You start by making 30 cents on the dollar. Branded companies, Winder, Manduka, Ragnar, they all have gross margins much over 50%. In some cases, they have margins as high as 70%. So for every dollar that you sell, 70% of it is then used for profits and for paying your expenses. So I love businesses that have a strong brand associated with them because you get great margins. The other thing I liked about this one is limited competition. You know, when I was coming out of Stanford, I thought about going into venture capital. And, you know, because I had a technology background and I was in Silicon Valley. And I didn't, one of the reasons I didn't is because all the smartest people that I knew were going into venture capital. It's kind of interesting to think about. And so I thought, well, you know, here's a way for me to go into another market where you have more limited competition. And in Winder's case, it was really at the time the only home delivery grocer in Utah. And when we moved into Vegas, it was the only home delivery grocer in Vegas. And now we're in California and there's more competition there. And we're getting more competition over time. But you know, the competitive environment here was pretty good. Okay, so sources of financing. So how can you pull this deal off without putting a lot of money into it? And I'll speak generally about this, and then I can speak specifically about how we pulled this one off. But when I often see entrepreneurs who are able to buy businesses with using very little, if none, of their own assets. And here's the way that you do it. One is you simply go to a bank. A bank today, if you have a good deal, a bank today may give you 3 times of their cash flow in a loan. So if I'm willing to go and I'm willing to pledge my personal assets, the bank will give me, if I'm buying a business, they'll give me 3 times their cash flow in a loan. So if you're buying a company for 4 times EBITDA, you're almost there. Now, you know, it's hard to find companies sometimes to sell for 4 times EBITDA, but I'm telling you, we've invested in a lot of them. So one is to go to the bank for financing. I was working with a student here at BYU who recently got financing, and he got it through an SBA loan. The downside of an SBA loan is that you have to secure it for your own personal assets, which I am always reluctant to do. And his comment to me was, I don't have any personal assets. So, I mean, I'm just graduating from college. All I have is student debt. I have no house. I have no savings account. But what the bank wanted is they wanted me to show commitment, and so I was able to sign the personal guarantee, which I think is true. The other one is seller financing. So we had a company that we were trying to sell last year, and the purchase price was $28 million. And what they asked from us is to provide $22 million of that in seller financing. And then they're going to get bank financing for the rest. And so, you know, we didn't do that deal, but seller financing is a component of almost every deal that we do. Is that when you're buying it from somebody, they're giving you part of they are financing part of your purchase. You know, we bought a company in California, a very small company, you know, 2 years ago, and it was a $3 million purchase price, and they financed $1 million of it with their own seller financing. So after 5 years, we have to give them their $1 million back, and so we had to go, you know, put in $2 million of equity. So seller financing, you know, between a bank note and seller financing, you can often, you know, finance a lot of the deal. Vendors. So when I started that conference business, I financed all of it through vendor financing. And so my expenses there were, I had a marketing agency who was doing customer acquisition. I had a hotel who was providing me, you know, all of the rooms. I had a food and beverage service providing some of the food. You know, I had a company who was building our website. I had all these vendors. And what I did is I negotiated with them that I would pay them 60 days after the event. So, you know, building up my revenue up to this event, I'm charging sponsorships to company sponsorships to come to my event, to be a sponsor of the event. Now I'm charging attendees a ticket price. I'm collecting all of that money up front, and then I'm paying for it all later. So I financed 100% of that business on the backs of vendors. Another piece that you can go to financing is real estate. We invested in a company once that had $3 million of real estate, and our purchase price was $1 million. But the company was troubled, and so they couldn't get a loan on their real estate. And so what we did is we bought the business, We operated it for about a year. And then what we said, and as part of the business, we got the real estate. After operating the business for a year, we put the real estate on the market. And we agreed to lease it back. And a buyer came in, they purchased the real estate for about $2.7 million, which would have allowed us to pay back all of our equity and then some, and we would own the business free and clear. Instead, we decided to reinvest that money into growth in that business, but real estate is a common source for financing a purchase. A lot of these businesses that have been around for a long time, they own their real estate free and clear. As long as you're willing to sign a long-term lease, you could do what's called a sale leaseback and finance most of your purchase. The other two ways of financing are investment partners. We've worked with several private equity firms where we want to diversify our own risk, or the check is too large for just ourselves. And so we partner with other local private equity firms. And then direct investment is you just, you invest yourself. And if you can understand this, you can finance a lot of businesses with a little capital. Any questions about this? A lot of it just along the way. When I started doing this, I was really kind of fearful of the bank process. I'm like, I don't really understand this. I'm more of an equity guy, not a debt guy, And the way that what I learned is that when banks are dealing with entrepreneurs, they're not necessarily expecting the entrepreneur to know all the nuances of a bank. I've learned it over time because I've been doing it for a while. But if you have the right idea and you understand asset value, what the stuff that you're buying is worth, you can find out what a bank is really willing to lend on that. And there's lots of rules of thumb. So for instance, a bank typically is willing to lend you 80% of your accounts receivable. And so if I find businesses that have a high AR, I know I can borrow 80% of that. Another one is inventory. Banks will typically lend you 50% of your inventory value. If you're doing a bigger deal, banks will typically lend you 3 times the cash flow. So there are these kind of rules of thumb that you can figure out along the way. But I would take maybe a snapshot of that, and as you're looking for deals, realize that these are all sources of financing. You just have to figure out how to leverage them. Other questions? Yeah. Yeah, so the bank one is the most risky because they sit ahead of you in all cap tables. So if something goes incredibly wrong, they're getting paid first. Same thing with vendors. Vendors come after banks in a downside scenario. The risk in financing is if you take on too much debt, you can't pay it, you're going to lose your company. But in most cases, and probably because I come from an equity background, I don't want to get over-levered in any deal. I'd rather put in too much equity and not have to worry about it. But also, I think if I were starting off for the first time and I was trying to buy my first business and I didn't have any equity to put into it, I might get a little bit more aggressive here. We bought a business that had, it was in a troubled situation, and they owed vendors about $800,000. And so when we came in, the senior bank, they got paid almost all of their money, and the vendors got paid $200,000 of the $800,000 that they were owed. We're basically buying the company out of bankruptcy. And I was teaching this once to a group of BYU students, and they said, well, isn't that unfair? You came in and you bought this company and you didn't pay off all their creditors. And I say that isn't unfair. Those creditors shouldn't have been paid, but not by the new acquirer. It was the previous owner who took on those obligations. So yeah, I mean, a lot of these have risk. Equity is the safest. So where are we today? So today the company does about $50 million in revenue. It's 10 times plus more profitable than when we bought it. I really believe we have billion-dollar potential. We're one of the fastest growing home delivery grocers in the country. 300 families have jobs today because we saved this business, and we're able to grow it. And it's a fun business. We have, if anybody's interested, we have a management development program. I'll just put in a little plug, where we hire a couple students, mostly out of BYU every year. We put them through a rotational program at the company. They spend 6 months in sales, 6 months in marketing, 6 months in finance, 6 months in operations, and they kind of get a holistic view of the business, and then they go run a piece of the business. So one of the graduates of that program is running our California operation. One is now running all of operations. One went and got an MBA at Duke and is now doing something else. So it's a great program to kind of develop as a general manager and to learn some of these principles of entrepreneurship. Okay, so final thoughts on entrepreneurship. One is learn to leverage your time, relationships, and capital. And I think this has been, something that I've learned over time, is that when you take advantage of the place that you're in right now. So think about being a student at BYU. You've got access to great professors. You've got access to alumni. You've got access to investors who want to be connected to the university. When I started one of my businesses in college, I went to a professor of mine. I said, hey, this is what I'm doing. What do you think? Yada, yada. He's like, oh, I can help you out. I write for Fortune magazine. I'm going to call them. I'm going to help them. I'm going to ask them to help you do your business. And he opened up a relationship at Fortune, which was very important to the growth of that business. And so really learning to leverage the relationships that you're around. Second is get incentives right. I spent a lot of my time today thinking about the people who are in our companies, and are we motivating them in the right way? In fact, on the way down here, I had a conversation with one of our CEOs and talking about how he should compensate his salesperson. And she's up for a sales review. She runs all their sales. She's doing a great job. So there's things that he wants her to do differently. And creating a incentive structure so that she does the right things the right way. I spent a lot of my time thinking about this, not just with sales and marketing people, but operations people, profit sharing plans, stock options. I think if you get the incentives right, you have to do a lot less managing. I'm a data-driven person. I'm not necessarily an emotional decision maker, and I think that served me well, is to gather all the data. I'm really big on long-term value creation. If you think about it, we first invested in Winder 10 years ago. I think we first invested in Ragnar 9 years ago. Our shrimp company maybe 8 years ago. My strategy is, if you have a good business, why sell it too soon? If you sell a business, you take a tax consequence, and then you have to reinvest that capital into a new asset. And so if you think about it, let's say you sell a business and you make 10 million bucks. And then, but after taxes and tithing, it might be 60% of that. So now I'm down to 6 million bucks. The next 4 million that I make just gets me back to break even, versus keeping my assets in the businesses that I know and understand and let them appreciate over the long term. I'd always pick the jockey. In the investment world, there's a lot of discussion on, what do you bet on, the horse or the jockey? The jockey is the team. I'd much rather build a company around a great team than to build it around a great company. Great teams will figure out how to build great companies. Diversity of cash flow. One of the reasons why I got in the business that I'm in today is because it allows me to have my hands in lots of different businesses. I don't have all my eggs in one basket, which means I'm probably much less likely to have a company that becomes $1 billion, but more likely to have lots of doubles, singles, and triples. And that's okay with me. And then finally, do not run out of cash. If you're an entrepreneur, the one lesson to take away is, so long as you have cash, you're still in business. I've seen great companies grow themselves out of business because they didn't understand this principle. They thought they were growing and they're making a lot of money because they were. They're making net income, but because they didn't understand their cash flow, they run out of money. Think about that, particularly, I think the accounting majors get that, others don't get that. So, I think I'm out of time. Actually, I got 5 minutes. I'll let you guys out early. I'm done. If you guys, yeah, a question. Why don't you come up and ask them when you're done so everybody else can leave. If you have any questions, come on up. Thanks for listening.